Welcome to Front Range Facts. This is Anthony Meisner.
This is Jim Merrion.
And David Cox from Premier Mortgage.
Thank you so much for joining us today. We have a special edition, which is why we're also releasing a video version of this, on the impacts of COVID-19. And it's our 2020 special real estate report coming from Boulder, Colorado.
So, Anthony, you want to tell them a little bit about who we are?
Absolutely. My name is Anthony Meisner. I work in sales at Land Title Guarantee Company, background in economics, and I'm pretty much everything statistics driven these days. And my cell phone number is 303-968-9868. And you can always get me at my email as well. It's ameisner@ltgc.com.
And I'm Jim Merrion, realtor with Coldwell Banker in Boulder, Colorado, and co-host with Anthony Front Range Facts podcast every month, as well as our other podcast, Get Real with Blockchain, which is focused on real estate and blockchain technologies. And you can always reach me at 303-548-0243 or jim@ourcoloradohomes.com.
Anthony and Jim, thanks so much for having me today. My name is David Cox. I'm the sales manager and loan officer at Premier Mortgage Group in Boulder. We've been operating in Boulder for about 30 years now, assisting clients with their residential mortgage needs. So definitely don't hesitate to reach out to me if there's ever any mortgage questions or mortgage needs that you have. My office line is 303-302-3839, or email address is D as in David, last name Cox, C-O-X, @pmglending.com.
And thanks for joining us today, David. We really appreciate you taking the time. I wanted to spend a couple minutes, with this COVID-19 special that we're doing today. How we're going to be discussing the information is looking a little bit at the national trends first, and then getting specifically into just what's going on in Colorado specifically, and talking about some examples from the both the Denver and kind of the north of Denver, Boulder County-ish data as well. We have the 800-pound gorilla in the space, Zillow, and when they look at their data, they said that new listings on their platform fell 19% from March 1st to April 5th. But early March, I think, is when California went into their shutdown. So, that essentially rolled out, of course, across the rest of the country. So March 1st is probably a pretty good starting point for seeing some of the real active signs of how COVID impacted the market. So total listings have also risen on their platform 2.5%, indicating essentially that there is a longer time frame taking to sell some of these listings. And then if you look, specifically at places like New York, San Francisco, as you can see on the slide deck, or if you're just listening on the podcast, we're seeing drops of anywhere from about 38% in San Francisco up to a high of 56% in Pittsburgh, and New York City, which is at the epicenter, lost about 50% of their listings. What is interesting about the impact on housing, and we're going to explore this in more detail, is investment firms like Goldman Sachs had this research note that they put out on April 2nd saying that because of the low inventory, the lack of foreclosures, the fact that we're not really overbuilt by new construction like we were in 2008, that they really don't expect to see a similar impact on housing like we saw in the 2008 Great Recession. So there will be probably, obviously some impact, especially this year from COVID, but they don't really see it necessarily happening on anywhere near the scale of 2008.
Yeah, Jim, I agree. The housing market is in a much, much different point right now than what it was leading into 2008. I've been in mortgage lending for about 17 years, so saw what led up to the decline in the housing market in 2008 versus what's taking place right now. Lending at that time was much, much different than what it is now. The financing options were all the way up to 100%, sometimes even over 100%. And when you see a decline in home values, people become upside down in their homes overnight. And if they've lost their job or they've seen a decline in their income, they're much more apt to walk away from their homes. Where we're at right now, lending has been much tighter over the last 10, 11 years. With the mortgage reform after the recession. So the type of homeowners that are in homes right now are much more highly qualified borrowers. They had to put their own money into the transaction. Additionally, a lot of homeowners have seen some significant appreciation over many years. So even a decline in home value is not going to put clients upside down necessarily as quick as it did leading up to 2008. So the amount of foreclosures that we're going to see this time versus 2008 is going to be night and day difference.
Mhm. Yeah, it's, no longer can you put your mortgage application on Post-it notes and hand it to you, right? So we've had some better
A
security.
little bit more than that.
David, did
Very
you want to
good.
talk a little bit about what's going on a national level from the mortgage perspective?
Yeah,
Yes, the mortgage market has become quite challenging on a lot of different aspects. With the job loss that a lot of people are experiencing, as well as a lot of salary type employers are having their salaries temporarily cut. Whether it's 20% or 80%. That does make things challenging from a mortgage perspective, whether they're in process of purchasing or potentially refinancing. The verification of employments are tightened up to closing, making sure that the income that's being used for qualification is not only still an active income source, but still at the same level that was used for qualification. And so we are having to get quite creative to try to keep a lot of these transactions together for clients that are being impacted financially from the COVID-19 impacts that we're seeing across the country. From a mortgage perspective and mortgage products, we're seeing some changes almost on a daily basis as it pertains to guidelines as well as investors that are available. A lot of the non-QM or non-qualified mortgage products are non-existent in the current market. Jumbo mortgages over the last week have become a lot more difficult to obtain because of the fear around default on the larger loans. A lot of direct lenders or brokers are struggling to fund those if their warehouse lenders have temporarily suspended fundings for those types of transactions, not only on both purchases as well as refinances. Luckily our parent company, Cherry Creek Mortgage, foresaw the issues that were kind of coming down and have put some temporary fixes in place so that we can continue to assist our clients not only on the jumbo financing but also on obviously the conforming, which are hedged products. The jumbo pricing still continues to be a little bit elevated, but that can change on a daily basis. The conforming rates have been all over the board since their extreme lows on March 9th. There were concerns about liquidity and capacity and increased rates by well over a full percent in a matter of a couple of days. The money that was dumped into buying mortgage-backed securities in late March brought rates down, and they've continued to be extremely low. So for the most part, a 30-year fixed rate mortgage is in the low threes, and the likelihood of them staying in that low 3 range is pretty high for the long term. The economy is not going to recover overnight as quickly as it kind of fell apart. So I do expect mortgage rates to stay extremely low, historically low, for the long term, which will help the housing market recover hopefully quickly once we kind of get through the stay-at-home orders.
So, David, in your best guess, I mean, where do you maybe see at the end of this year, where would a likely place be for mortgage rates on 30 years?
Yeah, I think there's still going to be in the low threes, maybe at a high point, 3.5 to 3.75, maybe a high point. I really don't see the mortgage rates increasing, beyond, 4% at any point over the next, 12, possibly even 18 months. They're going to retain, kind of the historic lows that we've seen here over the last, 30 to 45 days. Which will be a good thing for people who are just looking to cut their housing expense if they're already in a home, as well as all the buyers that have hit the pause button on purchasing. When they re-enter the marketplace, the historically low rates are going to help buying power with them.
Well, let's talk about a little bit more on that the national side of things. What some of those trends that you're referencing really are. The Mortgage Bankers Association, looked at the application volume for new purchases for homes, And, it looks like it's basically down 24% when looked at the week of March 27th of this year versus last year. So considering it's a, heat of the spring buying season, and we're up in activity from last year up until this point, the real impact is obviously even a bit greater than that. And then when you look at, a source like realtor.com, which runs one of the largest real estate portals as well, and, essentially during that same time frame, they're seeing the number of newly listed properties, fall by 13.1%, and then, 34% respectively when compared to this period a year ago. I mean, that's some big drops that we're really looking at. And I think, Moody's Investor Services, the credit rating firm, is also essentially saying that we're probably going to be down about 25% or so from this number last year, because we typically sell about 5 million homes, and they're projecting about 4 million sales instead for this year. So we are seeing obviously that drop in application volume, the drop in just market activity in general.
It is interesting to put that in perspective too, because over the past few years, there's been over 5 million total sales. So just to compare that to the 4 million that are expected, it should be quite a dip for the short term. But what else is going on a national level, Jim?
Well, I thought it was important today to help. This podcast and video cast today is really geared towards anybody who's either strongly considering selling a property, or has been thinking about buying but suddenly has put the brakes on it and is a little bit freaked out, as well as, of course, our peers in the industry who really are trying to understand from their micro level, what is a little bit more of the macro concerns. So the National Association of Realtors is always our trade group for us realtors is always really good with trying to survey large populations of our members to find out what the group essentially is experiencing nationwide. And so we had about 6,000 people respond to a recent NAR survey where they were asking them some of these important questions about what they thought the market was looking like. And the agents were saying that they've seen about 59% of these agents are seeing buyers delay purchasing for a few months. And anecdotally, for my own stuff, I'm seeing stuff go through, and I'm seeing some people say, hey, let's hit the brakes for a bit and just figure out where the dust is going to settle. And then, when they ask agents, about sellers, they're saying that sellers, 57% of agents are seeing sellers delay the listing of their home over the same period as well. And just in some of the real estate groups that I belong to on Facebook, you're seeing very lively debates right now about what the game plan should be, what your strategy, what your advice to your clients should be. And it's all over the board. It's some raging debates going on right now in that regard. And while 63% of agents said buyers expect a drop in home prices as a result of COVID-19 issues, 72% of these agents found that sellers are not reducing prices in the hopes of attracting buyers. And, when you look at, we'll get into the showing data in a little bit, it's really hard to say, hey, let's drop our price when there's simply not as many showings happening in this, month downtime that we're experiencing. Now, what I thought was pretty interesting was we had, Goldman Sachs, a little while ago in our discussion said that they don't really expect much in the way of a drop in home prices because of economic factors and, higher inventory levels. And Lawrence Yun, who's NAR's chief economist, the National Association of Realtors chief economist, he also stated that he expects price stability because we already had much reduced inventory before, and there's also less immediate need for foreclosures because a lot of these banks are trying to work with people. I've seen it on a number of bank sites I've been on recently where, like, right on the front page, they've got like a COVID-19 deferral or forbearance request button and stuff like that. So they're trying to make it a lot easier than the kind of chaos that we saw over 2008 through 2010, where there's some federal programs, but it just seemed like a lot of the banks really didn't care too much.
I want to touch on one thing real quick there, Jim. You'd mentioned, forbearance and deferral. We're seeing a lot of that with mortgage servicers and banks. There's a lot of unknowns as it pertains to the forbearance with mortgages. Any client that's, running into financial difficulties and reaching out to their mortgage servicer in regards to a forbearance, I think it's extremely important that they find out all the details. A lot of the forbearance programs are simply just deferring the payments for 30, 60, or 90 days. And then those homeowners are going to have a lump sum due at the end of the forbearance period. So before they enter into any sort of an agreement by not making the payment, they want to make sure that they understand when that money is due. Ideally, they would be entering into a deferment, which would just put the mortgage payments at the end of the mortgage note, not having any sort of a lump sum due in the short term. And then, just making sure there's no negative impact to credit in the short term as well.
And David, to help people at home who may be listening or watching this that are considering doing something like that, would all this information then be in an agreement that they'd have to sign with their bank? So it'd be spelled out clearly so they wouldn't have a surprise, say 60, 90 days later?
Correct. Yeah, I mean, it's all going to need to be documented anytime they're entering into a forbearance or an agreement or any sort of a modification of the original mortgage terms that they took out.
Okay.
The scary part is, clients who are homeowners who are experiencing financial difficulties, because they're out of work. It is very likely that they're not going to have 2 or 3 months of mortgage payments saved up if there is a lump sum due, in the near future. So potentially staying away from forbearance and really trying for the deferral, which once again is putting the mortgage payments at the end of the mortgage, basically pushing the maturity date out on their current mortgage terms.
Okay. And are some banks, because I know, like, at least when they were talking about this, aren't some banks even saying that there might be 12 months of payments for people who are really getting hit hard on this, that they could maybe, say, tack on to the end of their loan?
There's a lot of different things being discussed, and it's not clear on any sort of a blanket policy for conforming or investor specific type loans that would be offered through banks or financial institutions. So just finding out the details, making sure that they're clearly understood is my best recommendation to any homeowner who's reaching out to their bank or their mortgage servicer on that.
Okay, great. Hey, Anthony, you want to give us a little perspective on what's going on with COVID in Colorado?
Yeah, now that we're kind of wrapped up the national stuff, let's take a look at Colorado. And I think just to put this all into perspective for everyone, let's take a look at what's actually happening with COVID-19. So this is something that we found. It's a hospital resource guide, but it's basically showing you kind of the trajectory of the expectations of when we're going to peak this thing out, how the hospitals are handling it with capacity and that type of thing. So if you're listening at home and you don't get to see this beautiful graph in front of us, it's basically stating that they're expecting the peak of COVID-19 at the hospitals to take place around April 11th. Currently, we are sitting at about 120 or 137 ICU beds that are needed, but we actually have a capacity in Colorado for 554. So that's really good news, knowing that if everyone stays home and we don't keep spreading this thing, the peak will take place soon. The other metric that they're tracking is that there are about 4,851 total hospital beds in the state of Colorado, and only 1,409 of them are in use for COVID-19 right now. The one thing that is sort of concerning was right now we have about 200 ventilators that are needed that I don't think they have yet. So this is a pretty interesting chart, but what it really points out is if all of the measures we put into place are doing their job and working well, the end of hospitalization for COVID-19 is projected somewhere around mid-May. And what that really means is all of the active cases in the public should be completely done somewhere around May 1st. So we'll see if their projections are correct, but that's why everything is kind of showing April 30th is the end of the stay-at-home orders. But I mean, it updates every day, so we're taking a look at this and kind of keeping track of it. But at least it gives you some perspective as to how long this is going to last and how hopefully we'll be back to showing houses and selling real estate here in no time. Do you guys want to give a quick plug for yourself real quick again with your information in case anyone missed it at the beginning?
Yeah. Well, thanks, Anthony. Again, Jim Merrion with Coldwell Banker, real estate agent and based out of Boulder, Colorado. And my phone number, if anyone would like to reach me, and why wouldn't you want to reach me? 303-548-0243. And my email address is jim@ourcoloradohomes.com.
Excellent. My name is David Cox. I'm the sales manager and loan officer at Premier Mortgage Group in Boulder. My direct line is 303-302-3839. My email address is D as in David, last name Cox, COX, @pmglending.com. And I'm more than happy to answer any sort of questions or obviously assist with any mortgage needs that you may have.
I'm Anthony Meisner with Land Title Guarantee Company. You can always grab my cell phone at 303-968-9868 or email me questions at ameisner@ltgc.com. Here's a quick stat that Jim put together for us and grabbed from the Denver Metro Association of Realtors. And our big premise here about looking into how this isn't going to be another 2008 all over again. This was just to give you guys some perspective. So if you're listening at home and you can't see this chart in front of you, this is all active inventory and sales from about 2008 all the way to current. So Jim, what's the concept here?
Well, I think, when we're looking at quoting Moody's analytics, we're quoting, the head economist for NAR, all saying that they don't expect it to be 2008 all over again. And one of the big reasons was inventory and overinflated building and things like that. What this chart really does is illustrate very well kind of why they're conceptualizing it. And even though they're talking on a national level, in Colorado as a whole, and this is specific, this chart is just a grab from the Denver metro area. But what's phenomenal to think about is that in 2008, around this time of the year, we had about 28,333 active listings on the market. So again, 28,333 active listings on the market. Right now, at the end of basically January, is the furthest back I could pull this one report from, we're at 4,835 active listings. So we're essentially 24,000 listings less than we were at this time in 2008. So we've had several years of really rotten inventory levels, essentially since the rebound occurred, back in 2012 or so. Our inventory levels have been poor. And, that's helping us in bad times like this now, where people, if they do have to sell, there's just not a lot that they're competing against. So there isn't as much price pressure downward. Not to mention there aren't all these inflated property prices because of the inflated, lending that was going on, that was endemic during that time. So very tight inventory. It really has not kept up with the demand, since we have never even had more than 2 months of inventory in most price points for the last few years. So because of those technically difficult buying times, it's really helping to sustain price points in the market, and should keep us weathering the storm fairly well in Colorado.
An interesting part about this too is the first quarter this year has been just amazingly good because of low interest rates. Before COVID-19 hit the United States, the real estate market this year has just been booming. So with that in perspective, that just means there's a lot of demand, and that amount of demand looks like, it looks like that amount of demand is going to just be like a pent-up demand. If we look at kind of the world real estate markets right now, everybody who's over COVID-19 into China and other places, they're having incredible success with the real estate market just going full speed ahead once again. Everyone has to have a place to live. As long as you aren't completely going to be jobless at the end of this, it looks like from a consumer perspective, people are just kind of picking up as business as usual. So it is good to see that. Hey, Jim, do you want to tell us a little bit about what's going on with the showings and the new regulations from your perspective?
Sure, Anthony. As we've been trying to wade through this, ever-shifting changes to the marketplace, the Attorney General this week issued an opinion on the governor's order of sheltering in place. Prior to this week, when you look at the governor's order, it was very vague. It just defined real estate as an essential service. so inspections could still continue, and all the, marketing to get listings started could continue. And the Attorney General basically came out with this week that got pushed out to us that said that anything that's transactionally related, meaning anything that's contained within a contract, so contractual obligations can continue to go forward, but anything that's marketing related, meaning showing properties in person or doing open houses, which had kind of already been ixnayed, but those types of activities and the marketing activities related to listings in general, it just is basically stopped until the end of the month, until that shelter in order place is lifted. And what that has done is obviously it's now made showings essentially drop to zero. So hopefully if you're a listing agent, you've had a virtual tour created for your property so that people can continue to look at those online. But the in-person showings right now are not being allowed at all. There's some questions, gray areas still as to what listing agents are capable of doing, if it's just them themselves in the home or whatever else. But in general, we're going to see showings essentially hit close to zero, if not absolute zero, for until the end of the month. And so what we have on the screen right now, if you're not in front of a computer, just listening to this via podcast, we essentially have a showing time report. Showing Time is the company that schedules most of the showings in our state, and they have created this wonderful graph that looks at the first 7 days of January as kind of a zero line, and then as each week progresses in the year, how much the showing activity increases, since that's traditionally the low point of showings, or right around the low point of showings for a year. And so we started out with a very good year. It tracked very well with 2019. In some cases, it got better than 19. In other cases, it dipped just a little bit below it. But we were definitely seeing a large uptick at the beginning of March that was surpassing 2019 activity. And it really seemed, it felt like the momentum was there to push us to a record year with number of showings and with just market activity in general. And then what you can really see about when Europe got shut down from travel, when Trump shut down the travel to Europe, that's when the market really started to shake a bit. And, the showing activity right now is essentially off of, this time last year by about 78.8% in showing activity. And I anticipate it to drop to, again, about, 98% or so when all is said and done in this regard. So our showing activity has certainly gone way down. Our virtual showing activity has gone up, but that's a much, much harder number to track since there's a number of different, virtual tour type platforms. So the reporting data is very disparate in that regard. And so I think it'll be hard to really, at least until all these companies, now that they've had this COVID thing, maybe they get together and have some sort of universal reporting they're able to do. But as of right now and for the foreseeable future, showing activity, showing reports activity is going to be very insignificant in our calculations because of the fact that we're just not allowed to do anything for the rest of April.
Yeah, it does look like Showing Time is asking agents to log the showings, regardless of whether or not they're on at this point, just so they can continue to track the data. But like you said, I mean, that relies upon the agents actually communicating with Showing Time when they really have no need to communicate with Showing Time to do a virtual showing, even if it is, whether it's a virtual tour or something like that. So
it's not just the agents though too, because when I send say 10 listings to a client to review, there's links off of those there for them to view a virtual tour, and I have no idea whether they're doing that or not. So that any kind of self-reporting is just not going to fly. I have talked to my photographer about getting reporting off of Matterport, which is the product I use for virtual tours. And he's told me that Matterport has just horrible reporting capabilities that you basically have to do database queries to be able to see any kind of activity. So I don't really see this getting better anytime soon. So I think we just need to kind of go with it in a lot of cases as to what the market's saying.
Yeah, we'll just have to hunker down for 3 weeks and hopefully be done with this.
Mm-hmm.
All right, so let's take a look at Boulder County data. Thank you so much, Jim, for providing all the IRIS data so we could take a look at the local stuff. This should give you guys just kind of a basic idea of what's going on and kind of what's happening as far as total showings as well again, but there's some other data in here I think that can tell you kind of about what market activity is happening and how that's all shifting over these times. So we're taking a look at data every single day, and you can look at the beginning of March. That was a pretty traditional amount of showings that you were seeing, and then it trickles off every week as we get more and more regulations slapped on the real estate industry, and all of us had stay-at-home orders. And you can see about March 22nd where that was the beginning of the stay-at-home order. If you are not declared an essential business, and that's when people really stop taking a look at properties. You do see spikes. Every one of those, the mountains on that map basically show Saturday's activity for showings. So you can see all the way down to the point of the last couple of days where realtors weren't really allowed to be doing showings. You had like 18 and 24 showings per day. So those are probably people reporting some sort of virtual showing. So as you can see, it's pretty insignificant. This would be day-to-day in Boulder County by actives, pendings, closed, and month-to-date closed. So it is interesting to see that the active inventory levels haven't really dropped off a whole ton. They did a little bit, but they're staying pretty flat at this point. So I think people are not really pulling inventory off of the market. There's very little going under contract, but what is going under contract seems to be replaced by some people putting active listings up right now. The pending number in red is the one that I think gives us some idea of where this is all going. These are all active contracts that people are working on getting to the closing table right now. So from contract to close usually takes, let's call it 30 days, where right now there's been a lot of extensions written. There's been a lot of people pushing closings up to get them closed, which would be that green line's closings. A lot of people push closings into March from April. We saw it all over the place across the entire state, Atlanta. That number peaked somewhere around 200 or 226 in Boulder County. We're like 209 right now. It's going to start to taper off a little bit over the next month, but we're just keeping an eye on this. And if you have questions, definitely reach out to one of us and ask, because we're all taking a look at this stuff every single day. This is the slide that is on Boulder County absorption rates. And an interesting piece about this is it looks like traditionally absorption rates over a 7-day rolling average, they're about 2% per day that's being absorbed in the marketplace because we have such low inventory levels. Let's say 1.5 to 2%. You can really see the effects of COVID-19 and people's buying in the last couple of weeks. So if you look at March 22nd, we were at about that, let's call it 1.5%. And that number, it was just what people were doing at the time in a cautious market. But as you started to see the stay in place orders take place, you're really starting to see that absorption rate over the 7-day period trickle down, which just means people are not putting properties under contract, and they're actually putting less under contract every single day from what we can tell so far. It's really starting to level off. And now that we're not able to do showings, I would imagine that this will continue to decline. So this would be a very short-term view at what's going to happen in the real estate market, but this is definitely, like, we always look at leading indicator data versus lagging indicator data. This is definitely leading indicator data. Absorption rate is one of those that it's kind of complicated to talk about and understand, but it's very, I mean, you guys can see the line if you're tuning into the video cast of this, where it's drying up fairly fast, and I would expect once this is all over, it to return right back to somewhere around 1.5 to 2% or so, because we are going to have just such a low inventory level at the end of this. Jim, do you want to talk about some other Irish stuff?
Yeah, and so, here in Colorado, we have 2 realtor databases. We call these MLS systems, multiple listing services. So we have our RE Colorado, which is more focused on the Denver metro area. And then we have IRES, IRES, which is focused more on north of the metro area up to the Wyoming state line. So I spent some time pulling out some information, looking basically at that middle of March period to April 10th for 2020 and for 2019, because I was really trying to understand, how much of an impact across different buckets of information are we seeing due to COVID. And David, I'd love to, hear your take on this as to whether you're seeing, since you're, the sales manager, if you're seeing, contracts fall out at all or anything like that, because it seems like we're staying rather steady. When all said and done, while we're seeing a lot of reduction in showing activity, it seems like people are concentrating their efforts in a lot of ways, and focusing on, getting the job done more efficiently. Because we did see this year, we did see in this period of time from mid-March to April 10th, have about 843 listings come back in the market, whereas last year we had 469. So there certainly is some impact, looking at those numbers. We have only 1,377 homes under contract during this time right now, whereas under this period of time last year, we had 2,218 that were under contract. But again, touching on the inventory levels and the market activity, we still are seeing fairly much comparable activity in the sold listings, and then in the total number of listings in Iris. This year we have 3,413 listings right now during that period of time in Iris, and in 2019 we had very close to the same at 3,609. So that inventory level, again, extremely low, and really helping provide some resiliency to the market. And the sold listings this year during that period, 2,429, and last year was a little bit less at 2,384. But there were a little bit more withdrawn listings during this period. We have 672 that were withdrawn this year, but last year there were 470 during the same period of time. So there's always an ebb and flow, with deals that are, going off the market or with being pulled off, or, price changes. So it's interesting to see. But what I thought was kind of interesting was this last stat, where in 2020 we had 810 listings change their price. In 2019 we had 1,033 change their price. And since the inventory is relatively similar, I think some of it has to do with the fact that because showings have dropped down so much, listing agents are unable to figure out whether it's the price of the listing that's having an impact on their not selling, or if it's this COVID-19 issue. And so I figure about 20% of listings out there would have probably have dropped their price, but they did not. And that's why we have a lower number this year than we did last year.
Yeah, I think that a lot of the conversation right now around everyone is, well, do I leave my listing on the market? Should we take it off the market? I mean, what really is happening? What's the, is there any value to leaving up a listing on the market right now? And I think for everybody out there listening, I think the moral of the story is people are sitting at home bored. If you look at Zillow's getting like 3x traffic of what they were previous to this, because people are at home. They're all with their families, or maybe by themselves, or whoever they live with, realizing they don't really like their house as much as they thought they did. Maybe it's not enough space. Maybe it's time to move up. I really think this is going to be a time where we have a lot of pent-up demand, and people are going to come out of this going, maybe this is a really good time to move into a better product type. Loans are going to be cheap, right? Money's cheap right now. It's going to continue to be cheap after this, as soon as everything gets kind of worked out. Obviously, we're not going to the government's not going to just completely let the mortgage industry just stop functioning, right? That's why we're all going to continue to be able to do our jobs. And I really think what you're going to see after this is a lot of consumers take a second look at their home and say, okay, do I need to remodel? Do I need to trade up? And the truth is, like, the majority of the unemployment that's taking place right now is due to executive orders, and it's going to probably go back to a much lower unemployment rate fairly quickly after this is all done. So a lot of these numbers are pretty interesting. We've been in such a great market for so long that people forgot what's going to happen, but I don't think we're just going to immediately fall into some crazy recession. I mean, this is just such a strong real estate market, and has been for so many years. And with such a great first quarter, demand is just so high. So from everybody we've talked to, from all the data we're really looking at, I think there's a lot of positive signs. You look at some of those charts that we showed a minute ago, it looks like gloom and doom, but the truth is there's not a lot of gloom and doom in the real estate market right now. I mean, contracts aren't changing prices while they're under contract to get them to close very often. People aren't falling out of contract unless they lost their job and they were a service worker. I mean, obviously there's scenarios where things have changed, but at the end of the day, real estate is going to continue to go forward. Real estate is such a big pillar of the economy here in the United States that I would expect Colorado to lead the way, as we usually do.
Yeah, on the lending side, just to kind of touch on that, that we definitely have lost lost some buyers because of their change in employment status or potentially their income. Some buyers just reacting out of fear and terminating contracts. But at the same time, we're seeing clients that have been shopping for 6 months, 12 months that are kind of re-entering the marketplace, or maybe being a little bit more of an active buyer, as they realize that this is an opportune time where there are less buyers out there actively shopping, and it's a good opportunity for them to be more competitive, potentially go under contract on a home. So we're seeing both ends of the spectrums, and Anthony, like you said, I think that once we exit out of the stay-at-home orders, looking back over this, March, April, possibly May timeframe, it'll be a little bit of a blip in the radar, but I think things are definitely going to bounce back and be right on line with where they should be.
Jim, did you want to talk a little bit about what's going on the metro side of things, on the RE Colorado side of the state?
Yeah. Just to touch upon a couple things I found interesting was, again, we have the two MLSs, and our RE Colorado is the Denver kind of one. And they have some data I pulled out there that I thought was interesting. Our active listing inventory during that mid-March to April 10th time period was 10,700 listings in RE Colorado. And in 2019, it was about 800 less, at about 9,880. And the total listings, meaning ones that are under contract as well as on the market, for 2020 is actually lower than in 2019, 15,500 roughly versus a little over 17,000 in 2019. And so because of that fact, again, lower inventory levels means that the buyers have less choices to choose from. And so they are going to be more focused on your property. There's just, that is a benefit to all this. And, I just threw in this thing as well, which we saw, a few slides ago. 2008, we talk about how there's total listings, right? That's all listings under contract, whatever else, at 15,500 for 2020. The active listings alone in 2008 were 28,333. So I couldn't even find what the all listings in the hopper at that time were in RE Colorado's data, but you can clearly see there's about 13,000 more active listings, versus the 10,000 that were in the whole state in 2020. So again, we don't have a lot of inventory that's going to be bumping up against each other and forcing each other to sell. And we do have some backstops the banks are at least trying to hash out and do, so people aren't going to be getting foreclosed on soon as well. And when you look at sold activity, right now we're trending a little bit downward. We have 4,240 listings that sold during mid-March to April 10th in RE Colorado data. And in 2019, we were about 300 higher at 4,556. Yet the median sale price in 2020 is up it's $415,000 is the median listing price that closes. And in 2019, it was $15,000 lower at $400,000. And when you look at the list price versus what you close price, that close to list price average in 2020, we're at 99.2%. So if you listed your home for $100,000, the median, the average sale price is going to be $99,200 off of that. And in 2019, it was 99.5. So very little difference in that. And that's reflected too in the fact that there's still less than 2 months of inventory, 1.8 months of inventory on the market right now. So still a seller favorable market, even though you can't let anyone in to look at your home.
Absolutely. One thing that I wanted to talk about a quick second as well, we focus a lot on the builder markets as well, when looking at kind of a macro perspective of Colorado. And the estimates in the last decade are that we're well over 100,000 homes underbuilt, because there was just not been enough building going on, especially in like the condo markets. So when you look at, the whole Front Range, it's a highly desirable place to live. In times of crisis, people actually flock to metropolitan areas, and they move from places like rural America far more than they would in, you know, a positive environment, because the job opportunities and employment opportunities are so great. So with just the fact that we have well over 100,000 homes that probably need to be built just to make up the difference between, say, 2010 and today, and just the you know, the kind of educated guess that the amount of people moving to Colorado isn't going to slow down anytime soon. The real estate market is just so propped up here that everyone's starving for that median home sale price inventory level, and that's really where the builder population is shifting. Let's just call it the next 5 to 10 years worth of inventory is really more in affordable price points as well. These are all very positive signs for Colorado weathering this storm pretty well.
Well, thanks, for everyone joining us today. We just wanted to remind everybody that, all this information we're sharing obviously today in a video cast, but if you're listening via podcast, feel free to reach out to us and get a hold of that information. We wanted to thank our friend of the show and special guest today, David Cox, for lending in some information. And David, did you want to wrap up with anything, or you think we covered everything you wanted?
I just think in the current time, it's important to, get all the facts as it comes to whether you're an existing homeowner or seeking out a new mortgage. The mortgage industry does not stop, in a recession or in down times. So, there are a lot of options out there for homeowners to maintain homeownership. Everybody wants that. No one wants the foreclosures. So reach out to your loan officer, myself, or your servicer to find out what sort of options you have.
Okay, great, thanks. And what's the best way to reach you again, David?
Either my office line, 303-302-3839. I am working from home here, just like a lot of us are, so cell phone is a great way to reach me as well, 303-903-9065, or via email at D as in David, last name Cox, COX, at pmglending.com.
Great. Well, thank you very much for taking the time today to join us, David. And again, I'm Jim Merrion, realtor with Coldwell Banker based out of Boulder, Colorado. And you can reach me at 303-548-0243. And my email address is jim@ourcoloradohomes.com.
And I'm Anthony Meisner with Land Title. You can always catch me on my cell phone at 303-968-9868, or you can email me at ameisner, MEISNER, @ltgc.com. And don't forget, if you want a copy of the presentation, reach out to Jim or I. Don't forget to give the podcast a like, grab the video, share it with your friends, and reach out with lots of questions. We're just here as resources for you. That's the whole reason we put this stuff together. And hopefully you all get out there and have a great real estate year, and continue to educate yourself. That's what Jim and I are all about. We love the education side of this, so we're all going to continue learning every day together, and we'll all get through this. So thanks for joining us today on Front Range Facts.
Thanks. Take care.
Thank you.